The zero-DT phenomenon, because it's introduced so many more alternatives to people, it's created sort of an opportunity for traders to get more sophisticated, but also for traders to be a little bit have more of the gambling mentality. So we kind of get a little bit both sides of that. We get just more activity. It's easier for some people to enter into the field, I think, because you don't have that overnight risk. And then the people who really learn to put it all together, well, they can really take advantage of some of the attributes of these zero-DT options. A lot of people get into options because they hear the alluring stories of how you can use these for leverage and people double their money and they make a lot of money really fast with options. It can ironically kind of potentially serve our industry because it creates interest. Ultimately, it sort of separates out those who are willing to put in the effort and those who just had that, sort of impulsive interest into it.
How is current market fragmentation affecting execution quality?
Mainly overall, for most of the retail traders, it ends up being beneficial because it enables the opportunity to have these very, very, very low commissions, historically very low commissions, including zero commissions. And most of the people trading retail positions don't really care about the penny that they may or may not be giving up as a result of all the different types of orders and how market structure is today. I feel while there is some good and some bad, I think that overall it probably does end up being good for the retail trader.
What are you teaching traders about managing risk today?
This is always a hard lesson to impart on especially retail traders. I guess any trader who's only been in trading for a short period of time. Honestly, my mantra to them hasn't changed at all. It's always, there's the potential for a black swan event. And whether that potential has greater possibility now or has the possibility of a bigger event occurring, kind of doesn't matter to me and to my guidance, because we've always had to worry about black swan risk. We've always had to worry about tail risk, and trying to convince a retail person who's only been trading for 3 months and has just been selling puts and never had a losing trade, it's difficult to convince them that one day something bad is going to happen and this is not going to work.
Are defined outcome products and options-based ETFs genuine innovation or just repackaging?
It's kind of repackaging. We had binary futures for a long, long time, which never really caught on, and repackaging them to what they are, and the marketing minds behind it have ultimately made it a successful product. As far as innovation, I think there's some potential there for innovation, but I think there should be a little bit of caution too. I think that some of these contracts that are geared towards things that are easily gameable, where someone in society might actually know the outcome and have the opportunity to trade off that, where we don't really have the rules in place yet that might be considered insider trading. I think that the industry as a whole needs to take a good hard look at it and see what's really right for the industry and what we need to be really careful about.
How are AI and advanced analytics changing trader education?
Innovations in the past have always been better tools, but humans always had to use those better tools and figure out how to put them to use. With AI, we still have a little bit about that, but AI can kind of figure out how to put some of those tools to use as well. I think that sometimes when I'm on AI, looking at what they have to say about certain option things, every now and then I get some answers that I would say are wrong. In some regards, I think that especially retail traders, when they're getting on AI and they're asking questions, they're trying to figure out strategies, I think they have to be really cautious. I think they still have to realize that at this point, this is still a tool, and you're the person in charge driving this. You can use it to really scale almost all of the labor that you have to do, whether that's backtesting or feeding data into equations or what have you. I think that right now it can really empower people, but they have to appreciate it for what it is.
What are the biggest gaps in current investor education and suitability?
There's been a little bit of a pullback, I think, from education. I mean, not the OIC, they keep, educating the public in options, but it used to be all the brokerage firms would have an educational program out there, and that's always benefited not just the industry, but the company itself, because, you don't want your customers blowing up accounts because they don't understand how options work. I think that education is a great marketing tool for exchanges and for software firms and for brokers, especially, possibly the best marketing tool available to them. I think a lot of times it ends up being a missed opportunity these days to not have as robust of an education program as we used to see in the past.
How do you teach event-driven trading without encouraging excessive risk?
There's one prime example of how we do it. So we have an earnings trading system. And the approach that we take, which basically comes from my philosophy of these event-driven situations, is that you really can't predict them. You can't predict if a stock is going up or down when it comes to earnings. Sometimes not even with a Fed announcement or with monthly unemployment or something like that. The approach that I like to take and that I like to share with our students is to focus more on the volatility aspect. I like to trade personally time spreads before earnings. It's very situational. There's a lot of data that needs to be parsed. It's definitely not every earnings announcement that I trade a time spread on. But the ones that I do are based on strong criteria, and they're completely direction indifferent. That's the best way to look at these big events that can really move the market. And even if you do trade them directionally, the implied volatility component is such an important thing, often more important than direction itself, even if it is a directional move that you're trying to play.
What is your best case outlook for the options industry over the next 5 years?
I think that we are on a solid trajectory so far, and I think we see a lot of that growth from a few reasons. One, we keep adding shorter term products that create just sort of more trading without sacrificing liquidity, which I think is really important. I think we saw a great deal of growth back when we had the meme stock thing going on. We're sort of still in the tail end of that. I think that the people who got into the industry at that point, the market shook a lot of them out. The market shook most of them out. But the ones that stayed in, they figured it out, and they're trading bigger and bigger. I think there's a great deal of potential for continued growth. As far as one thing that maybe most people at this conference wouldn't agree with, I think is that caution about the event contracts. I think it's something that's moving ahead with a great deal of full steam, I guess you would say. But I think we need to really take a look at that to make sure that we're being responsible and benefiting people and not taking away the very important perception that we have responsible products that economically serve the public.